Thanks for clicking! Canada's real estate prices rebounded in July, and prices could be heading upward as soon as August. This according to the Canadian Real Estate Association, the CREA. Yeah, after almost a year and $25,000 worth of price losses, after Nostradamus told us that 2025 would be a slam dunk real estate market,
2025 has basically gone from a layup to a slam dunk.
We're now set to see interest rate cuts send prices moving upward.
We could start to see small gains as early as August, maybe September, October, especially September if the Bank of Canada cuts interest rates.
When I've seen this one, this is a classic.
It's brand new.
Yeah, this time, says the CREA, the long-awaited post-inflation crisis boost to the real estate market has finally arrived. But are there any real concrete indicators to suggest that this is the case? That A, the real estate market is finally about to take off, and that B, the Bank of Canada will be cutting rates in September.
That doesn't matter.
So what I want to do today is go over Canada's real estate data for the month of July, taking a look at why the CREA says prices could be picking up steam soon, search high and low for evidence supporting that argument, and then discuss some implications. Speaking of evidence, or lack thereof, some actual indicators of a Bank of Canada rate cut could be coming, with Stats Canada set to release its inflation data for the month of July this week, and we'll obviously have an update out on that data on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price is the price of a home that represents the most popular set of features, which was up marginally in July. June's benchmark was $688,500 and came in at $688,007 in July. And there is some good reason for this apparent flat pricing. If we look at the months of inventory measurement, the MOI, which measures if no more homes came to the market, how long would it take for Canada to completely run out of homes for sale, that was down in July, coming in at 4.4, down from a 2025 peak of 4.9. Meaning we are seeing a relative increase in demand compared to that of supply.
The number of months of inventory in Canada is now 4.4. It was 4.9 just a couple months ago. And so, that's moving very rapidly in the direction of a seller's market again. The long-term average is 5. So we never, in this 3-year slowdown, we never actually even got there.
And yeah, on an aggregate basis, Cathcart is 100% correct. Relative more demand compared to that of supply means there is a tightening in the market. With that said, perspective. First off, this isn't the first time that this has happened in the post-inflation crisis era.
What should I write then?
All of the green parts on this chart are where the months of inventory measurement was lower than the month before, with the last time being in November of 2024, when prices were $20,000 higher than they are right now. The market can loosen or tighten bit by bit here or there without indicating that prices are about to take off or that they are about to crash. Second, the CREA continues to tell us that the long-term average for the MOI is 5, but they don't give us any data to back that up. In fact, if we take a look at the data that they do give us, the long-term average is 3.5, so 4.4 months of inventory would be well above that. Provide, at minimum, the data to which you cite, or we'll just assume, at best, that you're mistaken, or that you're using your stooges in the media to push an agenda, at worst. And finally, on the increase in sales, which the CREA is quick to point out was the 4th month of increases in a row, which would be impressive, except that sales usually increase in April and in May, as we can see from the Toronto real estate data. That's why they call it the spring market, so of those 4 consecutive months worth of sales increases, only 2 of them are noteworthy. It's like if sales fell in January and February and I said that was evidence of a crash because they also fell in November and December, which they're supposed to, that would make me
An idiot.
Yeah, if I didn't know any better, but if I did know better and continued to push that deceptive claim over and over again, then that would make me
a realtor.
And if I repeated it over and over again until it became true. Regardless, yes, inventory is tightening, but it's tightening from a very large number. And we've been here before. We've seen this back and forth over the past few years. It's just too early to tell to make any assertive predictions. But what about those Bank of Canada rate cuts? Cathcart says that when the Bank of Canada cuts rates, prices could in fact take off.
We could start to see small gains as early as August, maybe September, October, especially September if the Bank of Canada cuts interest rates. But for now, flat.
And yeah, if the bank did cut rates, that could in fact cause a spike in demand. But the likelihood of the bank actually cutting rates? Well, according to the summary of deliberations released prior to the CREA's video, the bank maintains a laser focus on inflation. Further, if you actually read the summary,
Why?
baseline due diligence. If you're going to pretend to be an expert on the subject, at least take the 5 minutes and read the subject of your expertise. But if you actually read the summary, you'll find that the bank is balancing its approach, maintaining its stance that it's not cutting interest rates unless the economy weakens enough to pull down inflation. So we're either getting A, the weak economy with lower rates, or we're getting high inflation with higher rates, neither of which are exactly great for the real estate market. And there's just very little evidence that the bank is going to be cutting interest rates in the immediate future, with investors thinking there's only a 33% chance of a September cut, which Cathcart knows very well. And here's how I know he knows. Back during that slam dunk prediction video, Cathcart very much followed market predictions.
Up until fairly recently, market expectations for the winding down of this restrictive monetary policy that we've been experiencing over the last couple of years had been what forecasts tend to be, which is slow, steady, gradual. Now with the Bank of Canada having cut rates at 2 meetings in a row, the expectations for the unwinding are speeding up, the pacing. So at this point, cuts are actually expected at every remaining meeting this year. So that's September, October, and December.
So you do check market expectations, just not this time. You did, it kind of wouldn't work for that September narrative now, would it? And the evidence of an immediate Bank of Canada rate cut just isn't there, with Scotia and RBC saying we won't be seeing any cuts for the remainder of 2025, inflation soaring in the United States, cooling hopes that the Federal Reserve will be cutting rates in the immediate future, which would have definitely helped the Bank of Canada were it to be in a rate-cutting mood. Even Rob McClister of the Financial Post says we need to see a few positive inflation reports before we'll see any cuts. But who knows? Look, as we saw in Toronto, the market is tightening up a bit, but it is tightening up from very, very loose conditions. But the point is, we've been here before, where the CREA calls the beginning of a market takeoff, then something completely unexpected happens, usually something that was completely expected. That slam dunk forecast was released on August 15th of last year, and shortly before that, I released the following video, where we discussed that if Trump got elected, we would see him pressure the Federal Reserve to cut interest rates, that we'd see upward pressure on fixed mortgage rates due to Trump's relative fiscal profligacy, and tariff uncertainty leading to higher inflation and higher mortgage rates.
You don't know what you're talking about.
Which is largely what happened. So the CREA, the media, the powers that be, can, and probably will, continue to make these predictions, these assertions about the future, completely ignoring obvious exogenous factors that will affect it. They can, and probably will, continue to ignore these exogenous factors, but will, as they have been in the past, be perpetually in a state of shock when the completely predictable ends up materializing. We will obviously continue to track how these exogenous factors play out in Canada's real estate market on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.